last session of the day. So it's our lender panel debate. I've got some pre-prepared questions, as I always have, but I really would like to hear from you guys. So if I can ask our panellists to take to the stage, please. We've got Andy Dean, Head of New Build for Nationwide, Paul Eason from NatWest, Jonathan Evans from Skipton, and our very own James Ginley from eServe. If you can take a seat at the stage, guys, that would be great. Thank you. So I'm waiting. Hopefully the Chancellor is in Parliament, giving his statement to the House, and I'm waiting for Matt Brown to walk through the door with a slip of paper, and hopefully it's got all answers to all of our wishes on it. I don't think it will have somehow, but we can but hope. Afternoon all. So whilst we await some findings on the statement, you know, we've talked a lot about Help to Buy. We've talked about interest rates. You know, we've seen trading conditions marginally improve since the summer, with swap rates stabilising, lenders launching sub 5% rates. But the higher interest rate environment, as we've touched on, is making affordability even more challenging. Andy, I'll come to you first, if that's all right. You know, what are you expecting, sort of really, I guess, looking into next year, you know, around rates and sort of levers to help affordability?
And I guess in terms of the market, and we've sort of touched on it in some of the earlier sessions, you know, we'd expect the market is going to be sort of broadly flat next year, so we're not going to see a huge amount of growth, if any. But there are already sort of indications now, with, like you say, inflation dropping, with the view that base rate may well have peaked, with wage inflation exceeding price inflation, that actually from an affordability point of view, you know, if nothing else is done, actually you should really start to see some softening from an affordability perspective, where there's perhaps a little bit more scope for lenders to start iterating their affordability calculations, reflecting the sort of cost of living backdrop, and some of those pressures starting to reduce. It's not going to fundamentally shift, and I think we need to be clear about that, but I think we could well see a bit of softening in that space.
So we're seeing front-end prices come down, but obviously the key driver around affordability and stress testing is around the reversion, or the SVR. Jonathan, from a Skipton perspective, is that an area that lenders are looking at to try and, you know, is there something that could be done around the reversion or SVR rate to help with front-loading stress testing?
Yeah, so we've got one of the Skipton Building Society. We have one of the lowest SVRs on the market at the moment. Obviously, that helps us with affordability. You know, it's still going to be a volatile market. There's quite a big gap when you look at SVRs. There is quite a big ranging gap between what lenders are offering. So for consumers, you know, when you're looking at a front-end deal, if you're a broker advising, does that start coming into part of the advice process, or, you know, to take into consideration potentially? But, you know, the market was still a long way away. A lot of geopolitical events that could impact the market that are outside our control. In terms of swaps are obviously, you know, coming down quite healthily at the moment. But it really sort of depends on whether we get a hard or a soft landing next year. Bank of England has raised interest rates exponentially. We've got 450,000 people this month maturing off their fixed rate mortgage. We've got 1.6 million maturing next year. So it really depends on how well that beds into the wider economy, because when these people mature, they're going to be going to, you know, significantly higher interest rates, which means there's less money, you know, going about the economy. So a bit of a tightrope for the Bank of England, and we'll just sort of need to suck it up and see. But yeah, SVR wise, I think other lenders could look at, you know, can they reduce the SVR to help potentially, because we're doing it, and commercially we are okay off the back of it. Yeah.
Okay, thank you. And Paul, I'll come to you. So we've just been talking about affordable housing schemes. Shared ownership was a feature of that. Obviously, you guys were in the Help to Buy scheme. Is shared ownership something that, you know, NatWest are looking at? Obviously, you support HAs from a commercial lending side. Is that something that could be on the radar for you guys?
Yeah, it's been great to see the kind of really positive numbers coming out of the market for shared ownership and the other schemes. As a kind of responsible lender, we are always looking at the kind of more sustainable schemes, what can help customers get on the market and stay there for the long term. So yeah, really positive to see shared ownership. I'd love to see us being able to offer that in the future.
Andy, from a shared ownership perspective, obviously we've got the government grant funded product. We're starting to see, as Peter said, a few more private providers enter the space, and builders doing more partnerships with private providers. Vistry are changing their model as well. Not selling it in the typical shared ownership space. We've seen shared ownership typically with a share of about 40%. Builders are looking at 50, 60 plus. What's your view on that as a lender and scaling that product?
So we've had lots of approaches. There definitely appears to be quite a lot of innovation in that space at present. Like you say, lots of private shared ownership schemes coming to market, some with good distribution behind them as well. And we definitely feel there's a place for it. It's not vastly dissimilar to, I guess, the position that we were in a couple of years ago when there was lots of conversations happening about various different private shared equity providers that were trying to bring propositions to market. And we all know there's been challenges in respect of that. And one of the challenges that we've seen in that area was whatever is brought to market, lenders, particularly large lenders, are going to struggle to design or agree each of these schemes on an individual basis. So as much consistency as there can be is really helpful for the possibility of it coming to fruition. I guess when you look at the differences with these schemes, aside from what you said in terms of the minimum shares being typically higher, we are seeing a range of them, some that are registered providers, some of them that are non-registered providers. Some of them were the rent is in excess of 5% on the rent element, and I guess that's where you start to layer complexity in it, which is hard from a lender perspective to get around. But I do believe there is an opportunity in that space, and I know we're certainly looking positively at some potential tweaks in our policy when it comes to shared ownership, which will allow certainly some of these schemes to be supported by ourselves.
Yeah, because a lot of the lenders are geared up with that 3% baked into the affordability calculator off the back of Help to Buy. So if you've got a private scheme that's higher than 3, is the onus then on the broker to put that into an other box on affordability?
Speaking from our perspective, we've got percentages hard coded into the affordability calculator in the system, so it will look at what is declared, but if we feel it's too low, we'll add our own sort of buffer into that to make allowance for it. So there is a bit of tolerance in those systems, but it certainly doesn't stretch as far as some of those percentages that we're hearing about are actually placed right now. So yeah, again, and we often sit up here and talk about, well, why aren't we doing this and couldn't we do that? And we do blame systems quite often, but it all has to sit against priorities. And if you can get these schemes to market where they fit within the confines of what our systems will already deal with, and it's just minor tweaks to policy, then it does become quite viable that we can start to look at them.
So I want to go in, look at sort of innovation now, and I'll keep to bring James in as well. I've not forgotten you, James, on the end. But there's a lot of, James, I'll come to you first. So we've talked a little bit about future home standards, have been touched on a couple of times. There's, green mortgages has been touched on a little bit. New build premium, green premium, zero bills homes. There's a lot lots of positivity there, and lots of reasons to buy new. But it's not necessarily been reflected, I don't think, at the moment, but from a lender perspective around affordability and perhaps around their appetite of risk around LTV. So what's the ESA position on that?
I think we're at the tipping point, and it's interesting how it's been described today around new build premium being a standalone thing, affordability being a standalone thing. I would suggest that it's actually all wrapped up into one, and it's about affordability premium. And that, in part, is the green issue as well, because it's around understanding what people's ability to pay over the duration is. And I think that is a data problem at its heart. It's also a problem around how people are buying properties and how developers are selling those properties to them. I did use the car analogy on this stage at the last event, and I don't think we've really developed that. Buying a car, you know your MPG, but yet we don't know the long-term cost of bills before we purchase a property, which is crazy in this day and age. So I think we must get a lot better in understanding the long-term cost of ownership, and surely that is around the energy bill.
Yeah, and I think, you know, so we've seen some movers from some lenders, but Paul, if I come to you, so what is holding lenders like NatWest back around reflecting the, you know, enhanced or reduced running costs of a new build into your affordability?
Yeah, I think you just nailed it. It's the kind of access and the consistent use of data into that affordability model. We are now just starting to see kind of really good data to show the lower running costs of new builds and higher EPC properties. And so I can see a future where we can start to build that into the models. I think you mentioned the systems and tools and hard-coded things that goes above my head. But yeah, these are challenges that we have to face into.
And, you know, I mentioned earlier about zero bills homes, you know, guaranteed. You know, Bellway are one of the first, I think, to partner with Octopus Energy. So guaranteed zero bills homes for 5 years. Is that going to be enough to get lenders really excited and to make a change on affordability, Andy?
So I've heard about the proposition, and yeah, it's quite a compelling one, isn't it? Really, if you can move into a new home and you've got a guarantee that, you know, you're not going to have any energy bills for a period of 5 years, it's certainly something that, from a lender point of view, should give us comfort that, you know, affordability is going to be that much stronger for that type of applicant. I guess there's probably scope from a pilot point of view to look at schemes such as that. I think the challenge in rolling it out en masse is somehow we've got to identify that it's an Octopus zero bill scheme. So do we need to create a new scheme type in our system so we can recognise that and factor it for a different affordability level? It sounds like I'm going to blame systems all day here, doesn't it? But in terms of feasibility, I think that's the detail that we need to really work through, because we all see the value in it, absolutely, but from a practical standpoint, we've got to work out how can we deliver something that isn't going to be a poor journey from a customer perspective as well.
Because we're seeing that in EPC A and B properties already, so I suppose it's building on that. Okay, so sort of sticking around affordability, you know, Help to Buy effectively was a part-and-part mortgage. It was capital and interest on the 75% and interest only, albeit you didn't pay any interest for the first 5 years, but effectively that's what it was. There was no repayment strategy on it, other than you either repay it yourselves for a remortgage or you move house and redeem it that way. You know, part-and-part mortgages sort of have gone a bit quieter, and I guess there's a bit of nervousness around interest only without a repayment vehicle. Jonathan, what's the Skipton's position on, you know, just doing a part-and-part mortgage? Because that's in essence what Help to Buy was.
Yeah, so we are actually looking into, you know, intergenerational wealth. Can you use other family members to support the application? So for example, if you had a first-time buyer, massive affordability constraints, cost of living crisis, could you potentially have a product or a policy that aligns with, you know, doing part and part up to 90–95%, but having a portion of it on interest only? But, you know, the first time buyer's not going to have the assets to meet our current policy. Could we then look for an intergenerational, you know, solution potentially? But it's just trying to get, you know, the risk people within the business comfortable, and it is quite complex when you're making policy changes. You know, we are an innovative lender. We'll probably touch on that in a bit. It's just, you know, the complexities, there's system sort of restrictions as well, but it's really about getting good data, getting the people in the business comfortable, that we can actually go ahead and do it. But yeah, it's something that we're actually, it's on our pad. We've got a strategic objective at Skipton to help 100,000 first-time buyers between now and 2028, and we're well on track to doing that. You know, and part of that's going to be, for us to get there, we're going to have roughly about 50% of our lending to be to first-time buyers on an annual basis. So we have got a real appetite and desire to get there, and this could be one of the things that we add to our already multifaceted proposition for first-time buyers.
From an NatWest perspective, is part and part something that you can support? Is it something you're doing now? Because that's what Help to Buy was.
We're doing it for select customers just now, but not up to those loan to values. I can see the opportunity to help more customers onto the market. Again, it's that long-term capability, eventually owning their property outright, and standing on their own 2 feet, so to speak. NatWest already has a good gifted deposit policy. There's no required, no maximum percentage mix of the deposit for them, and we can help families set up agreed repayment strategies, or if that's what they want or not, at the moment already.
So, and this is all about a range of solutions. You know, I think we've said lots of times it's not going to be one solution for everybody. It could be part and part. It could be, we'll come back to your innovation in a minute. It could be shared ownership, private, government-backed. So I have got a bit of paper, and there is some stuff on it. I just need to take some time to digest it. Whilst I do that, is there a question from the audience? Nick at the back. You might have to shout it out, Nick. I don't think we've got a roving mic.
Nick McAlpine, Waste Platform. In terms of kind of new private market products coming forwards that are based loosely around shared ownership, obviously you mentioned the 3% systems issue, and I'm not going to blame systems, obviously, he's talking about systems either. What type of volumes of a new product start to get interesting for you guys, and how does that compare to where volumes were 3-4 years ago? Where does it get your attention? Because obviously systems issues are difficult. You've probably got 10 things on your monthly board meetings, of which you probably get 6. So how do we get these figures up, and what volumes start to make it interesting for you guys?
I think volumes, when you're speaking about volumes, what gets interesting for, or when does it get interesting to the point we would act? It really depends, because we've launched some things this year, and we genuinely did not expect mass volumes, but it was the right thing to do for society, and it was the right thing to do to help underserved customer demographics. So I think sometimes if it aligns with our corporate culture, our strategic objectives, sometimes we can act without having huge volumes. But the problem is when there's so many different priorities, so many options, and we are exploring private shared ownership. We are active in shared ownership at the moment. We've been approached about shared equity, private shared equity schemes. It's trying to decide what one, what horse do you back? And at the moment for us, shared ownership is the one that's sort of looking most favourable, and the data that was presented previously sort of backs that up. But it's just about, if there are system changes that need to be done, we need to make sure that we're doing the right one, and we can't do it all. And we're only a 3% market share player, so we can only, even if we did all of this, it's still going to have very little impact on the overall piece.
It's really hard to put a number on it, isn't it? And it doesn't just come down to volumes. It also comes down to, how does that align to, what we're about as a building society, our broader strategy, what level of effort it takes to deliver it, and how that sits in the pecking order against many other internal priorities that we might be wrestling with at that particular point in time. So I can't put a number on it as such. I guess for us, it's always simplicity is key. The easier it is for the end consumer to understand, the better. You know, one of our most popular propositions over the past 2 years has been our Helping Hand proposition that we launched, which gives enhanced affordability to first-time buyers who take a 5-year rate or more. And it's been extremely popular, and it's driven good volumes, and it's fit in with our purpose as a society as well. But consumers understand it at the end of the day as well. So it's a really hard one to sort of put an exact figure on it.
I think from a valuation perspective, we have the same challenge, and it's interesting, the smaller the scheme, the more difficult it is for us, because we've got to understand it more, to understand the impact on a particular given set of scenarios. But on the systems point, I think it's quite interesting that where we sit with that as well, because often on the small schemes, the valuer has to try and work something for the lender, work the policy for them, where the system won't cooperate with a mass market scheme, or a minor scheme. The valuer might have to administer it.
Thanks,
Right.
Nate.
Oh, sorry.
Go on.
I was just going to say, very similar to the rest of the panel. As long as it's meeting with the wider strategy of the bank, the purpose that we're aiming for, we've got a huge push on the environmental side of it, and green mortgages. NatWest have committed to having 50% of their book EPC or better by 2030. So the new build market sits right in the middle of that, and then helping customers get onto those markets sits right in the middle of that. So we're vastly incentivised to meet our commitments. So to do that, we see these as opportunities to support more.
So thanks, Matt, for the slip of paper. There is no stamp duty holiday or break or discount period, whatever. There's a lot of points here about there's no return of help to buyers, none of us expected. A lot of points about funding, you know, for local authorities and recovering costs of major planning applications in return for being required to meet a guaranteed faster timeline, so prompt service or your money back. We'll invest 110 million to deliver high quality schemes, unlocking 40,000 homes. So again, devil's in the detail with some of this stuff. 450 million to local authorities to housing fund to deliver 2,400 new homes. So again, devil in the detail. New development right to allow any house to be converted into 2 flats, provided the exterior is unaffected. But Matt has put in capitals, non-related, but good news, alcohol duty is frozen. so thank you, Matt. So there is some positives in the autumn statement, but not as much as we perhaps would have liked. So maybe, as Stuart said earlier, maybe a missed opportunity. There are, Matt's not put the details around tax cuts, but you know, it was widely published yesterday, wasn't it, around tax cuts. So there'll be a bit more money in people's pockets, but probably not going to make a massive difference to help with affordability. But yeah, and minimum wage, I think I saw last night. So you know, it's very much around the edges, isn't it? So probably not going to help a great deal of us in this room. So, okay, so let's go back to you guys. Question from the audience. Any questions? Yep.
Hi, David Conway from Claymore Financial. I was going to say we can't change the planning rules, but it seems we can at cost. But most of the issues around first-time buyers come down to deposit and affordability. The Help to Buy scheme changed the game. Sorry, thank you, Matt. The Help to Buy scheme changed the game, and it showed it was possible for people to buy property with a cash injection. That has possibly obviously come from government and private sector. Have the banks considered setting themselves up as a private equity investor in people buying homes? Because that way they understand the schemes. It doesn't have to be various different cottage industries, and they can lend on schemes and properties that they want to lend on. And secondly, when it comes to affordability, it was mentioned earlier, it should be easier for the next 20%, or sorry, the last 20% of a mortgage to be interest only, for example, rather than being 100 grand earner, 25% deposit and that kind of thing. It just allows people that little bit more to get onto the housing ladder. Has that been considered more widely than just one comment?
I'm not speaking specifically for Skipton here, but yeah, you know, I'm willing to bet that, you know, boardrooms up and down the country will be looking at should they as a lender have a shared equity scheme to use up some of the capital they've got in their balance sheets. Yeah.
Andy?
I mean, we've had loads of the conversations with the, the opportunities, the AHOWs, the OnLadder of the world about their propositions, and naturally you're always going to look at it and try and work out if it's something that potentially you could do yourself. I think in reality right now there's challenges around that, and there's not necessarily the appetite to do it. Obviously we have partnered with third parties. We launched through Deposit Unlock scheme, which is helping customers with smaller deposits, and so 95% on new build, and that's something that we were keen to get behind and support, and we still believe it's very much got a place and will hopefully grow over time. We do recognise it just satisfies one element of it at the moment, which is the deposit element, and the affordability is perhaps where the bigger challenge is, but there's lots of discussions and creative thinking going on behind the scenes in terms of how we might address that.
Yeah.
Not stuff that I could really sort of share at this stage.
And place in the London market where a property is 600 grand, a deposit of 30 grand, you still need a mortgage of 570. Well, to do that, you need an income of 150,000. If you're on 150,000, your deposit is 30 grand anyway. So that's kind of where we've certainly in the London market now, the deposit unlock scheme.
And I guess that's where shared ownership at that higher percentage share comes in. If we haven't got Help to Buy, that's where we're starting to see more builders do shared ownership at 65% share, and probably where, Nick, your product comes in as well at that higher LTV banding. I think you're looking at 60 to 80%, I think, from memory. Yeah. So it's yeah. And again, I suppose it's that myriad of different options, isn't it? So just on shared equity for a moment, and then we'll move it on. So builders' own shared equity was around for 20 odd years before Help to Buy. MCD came in, Mortgage Credit Directive in 2017, put a stop to it. There's a number of builders now, as I mentioned earlier, starting to look at going back into it, whether it's themselves or partnering with a company that's already regulated. Paul, is that something that NatWest would take right now? A builder's own or builder partner shared equity scheme?
Doing the shared equity, I think it was yourself that mentioned it. I think there's the challenge from saying yes is just the consistency and being able to manage that through on a case by case, area by area, or builder by builder basis. I get the fortunate position of saying, yeah, I'd love to do it all. As part of my role is about growth, but we would need to get really under the skin of how do we do it consistently, sustainably, and given the right outcomes for customers on a regular basis.
Andy, is
There's definitely scope to to consider more than consider that. Actually, we recognise that, as we said earlier on, affordability is the biggest challenge. Again, it's sort of how it sits within the confines of our broader policy. So at the moment, we will allow third-party equity share schemes. We will accept them. The key is, though, that the interest is free for 5 years on the shared equity element, and there's no schemes out there at present. Or there's one actually that's out there at present that I'm aware of that's supporting it. So the conversations with builders and these third parties, and I won't say there's loads of them right now. I think it's definitely sort of a bit, there's a bit of interest in that space, but the conversations tend to revolve around the interest that they're charging on that shared equity element, and can that fit within what our system currently models for affordability purposes. But if planets align with regards to that, then yeah, there is scope to do something there.
And if the HBF can get behind it, and in the similar sort of way they have with Deposit Unlock, and corral it a little bit with the lenders, then maybe there's some scope there. So I guess it's consistency, isn't it? That's the challenge when, as you say, big lenders, bit of a sort of sausage machine factory of stuff in. You need consistent parameters, don't you? So we've talked a little bit about trapped renters, and Jonathan, innovation. I touched on it earlier. Skipton have been quite innovative this year with your track record product. Do you want to just expand on where you're at with that, and what early success you've had? Obviously, it's not going to be open to everybody because of the nature of the scheme, but where are you up to with that scheme? And it is obviously available on new build up to 100%?
Yeah. Yeah, so it's available in new build. Yeah, it's available in new build up to 100%. It's specifically targeted at renters that have got a track record. So there was a slide earlier on that said, 20% of private renters can afford new build. And this product is available to buy on new build houses. It's for people that have been renting for 12 months minimum. They can demonstrate they have paid their rent for 12 months, paid their council tax, paid their utilities. Okay, so we obviously at Skipton we lend 95% LTV on new build houses. We don't do deposit unlock, we just do it off our own bank. But a lot of these customers come in and they've got a gifted deposit for family members. So I think Bank of Mum and Dad, I think it was Sun Life Research or Moneyfacts last week had a report out. I think it was £98 billion came from Mum and Dad over the last 5 years. So when you look at it, it's a calculated risk. There was a lot of publicity when we launched it. Oh my God, Skipton's back at 100%. This could be 2008. It's a calculated risk. So when you actually look at the customer profiles that are coming in, and I can't divulge how many we've done, but it is into the several hundreds. I need to keep that quiet because we're doing a media piece at the moment. But when you look at the customer profiles, the customers that are coming in on 95% LTV, gifted deposit, they currently live with their parents, and you then look across at customers that are coming in with no deposit on track record, but they can demonstrate their rent, their utilities, etc. When we're credit scoring the customers, they're actually performing better. The renters with no deposit are performing better on our scorecard and risk profile than some of the other customers. So it might look like a risky move, and obviously HPI, demand is where it needs to be, supply is kind of where it was in 2019. We don't see a massive crash in the market. We felt it was the right time that it's an underserved segment of the community. Some of the research that we've done, 86%. This was 2,500 renters that we surveyed. 86% dream of home ownership. 42% were willing to sacrifice. So your point earlier on, the guy that asked the question about London, this doesn't work everywhere. It works in certain areas better than others, but customers are willing to sacrifice. We are seeing customers that are willing to downsize to get on the property ladder. We are seeing customers that are willing to move to a less affluent area, and that kind of ties in with 44%, the slide earlier on, 44% of the demand is coming in for greater than 10 miles away. So it all seems to be adding up quite well. So it's been successful for us. It'll probably only be about 1.52% of our annual lending. But again, I'm going back to the point, but we're a 3% market share player. Yeah, 10th biggest lender, 3% of the market. We would love to see, some of the bigger lenders come in and backing it, because that would then really open the game up for more people.
It was certainly a bold move, and I remember being in a room with, I think it was a few days after you launched, and there was a number of lenders in the room, and everybody was quizzing your colleague, John, how have you done this, what are you doing? Probably taking the information back to their offices, so hopefully, as you say, more lenders will follow suit. Just over 5 minutes, and then we'll wrap things up. Any other questions from the audience? Oh, yeah, here we are.
Yeah, just one for Jonathan on the track record. 90% up to 95% on new build.
100% on, yeah.
On new build houses. But is there any scope to bring in flats, especially in London, where it would be needed the most?
On track record or on 95% LTV lending? Both. Track record, no. Straight up 95% potentially. It's something, as I say, we've got a strategic objective to help 100,000 first-time buyers. We can't just stand still. We're going to have to innovate more. So yes, the second one, we are considering it. We're looking at it. It's going through the modelling process. These things take time before they can be launched. But that, when you look at that specific question, and it's the same with deposit unlock. When we look at our back book, the last 5 years, we've helped maybe 3,500 people at 95% LTV, buy a house. There's very few of them going to arrears. So The ones that do go into arrears, the arrears are higher than the rest of the lending we do. But when you look at it as the overall piece, we've been really prudent in the last 10 years for the last recession. So it's allowed us, we're willing to go up the risk curve a little bit because our arrears book is one of the lowest in the market. So we can do it if we want to. Yeah.
Watch this space then, I think, on that one, John.
Just a point on 95. First of all, we support 95 on flats through deposit unlocks. I thought I've got to get that in there somewhere. But secondly, in the 95% market, we discussed affordability. It might not be a popular view, but I think one of the biggest challenges at the moment is the 95% market just isn't quite there at the moment. I believe the challenges that you see around traction with some of these products is the fact that, particularly in the new build space, if a builder's going to introduce 5% financial incentive into the equation and a customer's got a 5% deposit for own resources, then they're going to be down to 90% loan to value. So that's where we see one of the challenges being in respect of that. So affordability, I think, is constraining that high LTV lending. I guess the other point to call it out is that, as hard as the market has been, actually, if you look at overall product availability and if you look at, products that are out there supporting small deposits, there are still lots of options that are out there. We've certainly not seen lenders retrenching in any big scale away from those high LTV products. So I just want to sort of put a sense of perspective and context around the fact that there are still lots of options. We're always open to reviewing other things, but I think that the sort of wider challenges.
I think particularly given the narrative around house price reductions and that lenders haven't run to the hills as far as reducing LTVs, as you say, it's a massive positive and probably gets missed. It's just that, as you say, anything above 90, it's a very small market at the moment because of that affordability challenge. I just want to move it on quickly, James. So incentives, something we talked about yesterday at a meeting. There's been this sort of arbitrary figure of 5% that most builders do because most lenders cap out at 5%, and then they'll say, well, it's based on what the valuer tells us. It starts to impact valuation. I think we are starting to see and hear other builders offering a bit more, or it's a mix of 5% cash and some home improvements. Do we see room for moving that if builders wanted to give more, 7.5%, for example? Or
So as you say, it's very lender-driven in policy areas, and it was set probably about 5 or 6 years ago in people's psyches, and things can change, and I think things have moved on. We heard from Rob's slides that it's almost amazing that there's not more activity in the incentive space, but there isn't. So whether we need to look at policies, I don't think there's a great need at the moment, but one could see that the market, if it hardens further, then we need to be live to look at being more lenient in lending policy and therefore valuation around that topic.
Yeah, and I mean, we at ESA have acted for Nationwide and NatWest in new builds, so there's a conversation to be had around LTVs and things like that moving forward. So green, we've touched on it a bit. Obviously there's lots going on. We've talked about sort of future home standards and how that will at some point come to hit the market in 2025. A little bit of a way off yet. We are starting to see some lenders adopt this technology now, and obviously higher EPCs and so on. How are valuers looking at it? Is there a green premium?
So real struggle. It's a real struggle for us to know what's happening in the future home standard, as we heard earlier. It's a great problem for developers in designing what their build out is looking like for the future, the cost of build therefore, and then ultimately how they price differential future homes that are built to future home standard. We're tracking that. We're live to the fact that they could be differential, and it's for us to reflect that in the valuations returned. It's too early to say, I think, what that level of affordability premium, as I said, might be. But I think developers with that challenge need to get better at selling the benefit, specifically around the tech in property and the efficiency and the use of tech in the home. It's very poorly understood, and I think there is an education piece for us all to get involved with.
I think you're absolutely right there. I think having just had an electric vehicle a few months ago and then started to explore solar panels and batteries. It is a minefield, and people could do the wrong thing on retrofit. Even if there was an appetite to do it, the costs are quite expensive, long payback. So kind of if you want to go down that route, all roads point to new build, but it's consumer awareness,
Yeah,
isn't it?
and of course, consumer duty overlaid in that space, and great opportunity for valuers, to be honest, to be educating consumers in that space.
Last thing from me, conscious of time. So one of the things that we haven't really talked about today is actually the buy-to-let and investor space. But actually, as some of the slides have called out, that there's a massive demand in the private rented sector, undersupply, massive demand. We probably saw a few landlords thinking, you know what, I'm going to pull out of this because of the EPC stuff that was coming down the track in, what was it, 24, 25, and then 28 around bringing it up to an EPCC. That's now being kicked down the line for however long it is. Are any of you seeing a rise in buy-to-let? And I know there's some challenges with the higher interest rate environment, but are we starting to see a return of landlords? Could that be another market for builders to look at, with, given there's a shortage of PRS stock?
So through the mortgage works, we did see an increase in application volumes from buy-to-let investors purchasing new build properties. But the rise in interest rate environment and the challenges that you've said there, Craig, in terms of the impact that had on ICRs and making rentals stack up, has definitely sort of pushed that down the road. I guess what we do believe is that it's still an attractive proposition to an investor. Whilst the regulation might have been kicked down the road, the reality is it's going to come back at some point in the future. Whatever guise that's in, we don't know quite now. But with the change in interest rate environment, with interest rates starting to soften, swap rates softening, the pay rates that lenders are offering in buy-to-let reducing, some options there with higher fee products with lower pay rates, does mean that all of a sudden you can start to make it stack up from a new build perspective. So we definitely see that being a market that will come back and will grow. I guess what we have seen, and you see it in some of the builders' financial results, is bulk acquisitions for the PRS sector. That isn't necessarily a market that we play in right now, but you can see the attraction there for large-scale investors looking to acquire a large number of new build properties.
Okay, thanks, Andy. And we've run out of time again. It just flies by, doesn't it, these things? So I just want to say a huge thanks to all of you, the panel, for your time today and your honest responses. So thank you, guys. So we're almost there. So look, it's without doubt challenging. We've heard where we are. I think we're hopefully at the point of turning on the curve. Swaps are falling. The base rate, may have peaked, hopefully has peaked now, and we start to see it coming off maybe towards the latter part of next year. As mortgage product pricing improves, SVRs improve, hopefully all that will flush through to affordability. There is some innovation in the market. We touched on earlier, there'll be a new product launching in December. Shared ownership is obviously going to be a bigger part of the market. We just need more of it. We need more supply and not moving the deck chairs around. But and obviously we heard from Stuart around some of the work they're doing with HBF, with government, and trying to address some of the planning challenges. So, I think again it just points to we've got to keep talking, haven't we? We've got to keep talking as an industry. Just keep nudging all of these things forwards. You've seen what's in my intro. I keep badgering all the lenders around, chipping away at all these bits and pieces. And we are making a positive steps, but perhaps not at the pace that we'd all like. So let's see what comes in the new year. So the last couple of things for me is a massive thank you to first of all, Nationwide, Andy and the team, and all the work that you've put into hosting today. I really do appreciate it. Massive thank you to all of our sponsors and our guest speakers as well. Really do appreciate your time and your insight, and I hope you guys have found it useful. There'll be a lot of stuff that you know already, but there might be a few nuggets that you didn't know, and that can make a big difference sometimes, doesn't it? And as I said, we've just got to keep talking and trying to nudging the market forwards. We do send out an email post-event. You will get a copy of the slides. Will be included in the post-event email, PDF copies of all the slides, and there will be a link on there to fill an online survey. So we really do value your opinions around what you want to hear next time, speakers, content, subject matter. So please do fill that in, and then we can factor that into future events, because they're not just for me, they're actually for you guys, okay? And I am working on dates for 2024, so I hope to be able to confirm some dates on events for next year very soon. Before we close, Rob, have you got something for Mr. Dean? So there was Lisa. Do you want? Oh, you're right at the back. Stay there. Rob can do it. So we had an awards for one part of our business last week. TMA is our mortgage club. Works with our directly authorised partners, and Andy was highly commended, and it just seemed really apt that
I didn't make it on the.
And
evening.
you didn't make it. So remind us, Rob, what was the award for?
Market Insight Person of the Year.
Market Insights. There we are. So Andy, thank you very much.
Cheers. Cheers, Rob. Thanks very much. Thank you. Thanks.
So a really nice way to close.
Thank
Big
you.
thank you, Andy, for putting up with me over the last 6 months with planning and all the details.
It's been my pleasure.
Never again. Listen, guys, thank you all for your time, your questions, for your attendance, your ongoing support. Go and have a nice lunch. And if I don't see you before, have a lovely Christmas. I know it's early to say that, but we're nearly there. So all the best. Cheers.
Excellent.